Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, I'm Dongjia Shen, Tony. First of all, I want to wish everyone a happy new year for 2026. Alright, so today let's talk about these 2 titles. Actually, it's really just one thing. You say goodbye, I say hello. So let's just get straight to the point. This is from the Beatles, a song from 1967 called Hello, Goodbye. The song is basically about someone and the person they're interested in. Back then, it was a woman, but now, of course, we respect everyone. Respect, right? So as long as it's someone you're interested in, that's all good. In the song, he wants to show kindness to this person, but it seems like the other person is kind of giving him the cold shoulder. So it's like, when you say goodbye, I'll just say hello. And what's really fun is that in this song, the way they sing hello, it's hello, 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 and the pitch goes up. So this song is really interesting. So basically, since today is Friday, and it's also the first day of the new year, let's just take it easy, right? Actually, I want to tell everyone that the Beatles, their songs, if you have kids at home or if you want to learn English yourself, their songs are a pretty good choice, because if you want to learn, when it comes to language, singing is a really great way to learn. So what are some of the features of their songs? First, their melodies, especially from the 1960s and 1970s, are quite elegant. Second, the lyrics are very simple. They don't use any strange words, and they don't use rap or using things like African American slang. You won't really find that in their songs. Also, another point is that John Lennon's pronunciation is considered quite standard, so using their songs to learn English is actually pretty good. There are also other classic English songs that are great for English learners to listen to, but here we're just giving an example. Just sharing an idea here. So why did I think of this? Well, during this year's Chinese New Year, I saw a lot of people sending me things like Goodbye 2025 and Hello 2026, which made me think of this song. Of course, that's the reason. We're mainly focused on investing in US stocks. The most important thing for us is to look at 2025 as basically being over in terms of investment returns, if you think about it. 2025 isn't actually a bad year, but the thing is, the process from 2020 to 2025 has been pretty intense, so yeah. We have the trade war, and Trump started the trade war. Do you all remember? That was on April 2nd. Right around the Qingming festival holiday. And then after the whole Qingming holiday, it was like we got struck by lightning. The next day, what did we see? Stocks hitting the upper limit as soon as the market opened, or hitting the lower limit right at the open. These kinds of wild scenes you hadn't seen in decades, you saw them all. And of course, after an extremely tense and stressful week, by April 9th, Trump backed down. The stock market started to rise again from that day, and in the end, things turned out pretty well. So today, we'll quickly go over not just the outlook for 2025, but also, since the fourth quarter financial reports are coming out, roughly speaking on a per-share basis next week. Starting from the 10th, we're entering a new earnings season, so of course, we'll preview this final earnings quarter. But more importantly, what's even more important for us? It's definitely how we view the entire year of 2026. So let's break it down into 2 parts. For 2025, we'll look at the fourth quarter and the full year performance, and for 2026, we'll focus on the part about the full year outlook. Now, let's take a look at the expectations for 2025. The annual average earnings growth rate, that is the EPS growth rate, is 12.1%. This is actually much better than the 8.6% earnings growth rate from 2015 to 2024. But first, let's talk about something. The rise or fall of the stock index is one thing, but when we talk about, say, if you look at it from the perspective of foreign investors, not just brokerage firms, but actual foreign institutions and research organizations, they're actually pretty old school. They don't really care about how much the stock index has gone up. The first thing they look at is earnings. how much earnings have increased. That's the first thing they look at. Not how much revenue has grown, but how much earnings per share have gone up. Why is that? Actually, this is a pretty core value in capitalism. They pursue growth in shareholder returns. It's not just about shareholders getting returns, but those returns need to have a growth rate. So that's what we're looking at. The first thing they look at is the earnings growth rate. Now, 12.1% last year was pretty good, better than the past 10-year average of 8.6%. And then, if that's the case, just to confirm, it's 12.1%. Okay, but this can only be verified after the earnings season is over. So if that's the case, that's 5 consecutive years of earnings growth and 2 consecutive years of double-digit growth. That's actually pretty good. And there's another important number here that everyone should remember. Here. The 5 major contributors, okay? Among them, 3 out of the 5 are from the Magnificent 7 companies, NVIDIA, Google, and Amazon. And the Magnificent 7 had a 22% earnings growth. Now, the other 493 companies had a 19% increase. This is very important, and we'll see why in a moment. So let's first look at the 2 charts above. We have a few tables here. There aren't many pages in today's file, but there are quite a few tables, so we'll need to slow down a bit today to look at the details. Okay, so first, let's look at this. This is about the change in earnings growth rate and revenue growth rate. Of course, the last part in red is the so-called estimated section, and it's all based on the calendar year perspective. In the US, as long as your financial reports follow your own quarterly cycle, that's fine. You can have quarters like January, April, July, October, or March, June, September, December. As long as your fiscal year lines up, it's acceptable. It's a pretty flexible market. Now, looking at this, you really need to pay attention to the past earnings growth rates. Of course, we see both good and bad results, but the biggest change happened when in 2020, earnings dropped by 10%, and then after that, things started to change. In 2021, there was a significant increase. So what happened then? That was the pandemic. The pandemic made that year revenues surge because for many places, especially Western countries, it was the first time they experienced things like lockdowns, restrictions, and pandemic control measures. So that had a huge impact. After that, of course, growth resumed. Now let's look at what happened next. The year with the most noticeable dip was calendar year 2023. So why was it worse then? Well, it was because we were in a rate hiking environment. In fact, after interest rates started rising in October 2022, there was an expectation that rates would peak soon. From October 2022, things started to pick up and the growth continued all the way to now. So let's take a look at earnings. The revenue growth rate is actually quite good. Now, as for the Magnificent 7, we really have to be honest here. If you look at their earnings growth rate, it's no wonder they've become the Magnificent 7. Why? Because their earnings growth is so strong. It's honestly really strong. Let's be real here. If you look closely, from 2020, let's look at the past 5 years since the pandemic. The performance has been impressive. In 2020, earnings were up 32.6%. Then in 2021, it was 49.3%. In 2022, due to the impact of interest rate hikes, it dropped sharply to negative 16.3%. But in 2023, growth bounced back to 33.3%. And then in 2024, it's 37.2, and in 2025, it's 22.1. So what I want to say is, if you look at this, isn't it impressive? I really think it's quite strong, which is why there's a reason it could become one of the Magnificent 7. We're also here to share this perspective with everyone. All right, so if you invest in Taiwan stocks, you might go for small cap stocks because they're more lively, there are more themes, and they move up quickly. And what else? Well, all the love and hate, all the drama, it's all in there. But if you're investing in US stocks, I would still suggest, this is just my personal style, but I recommend everyone consider it to actively look for them yourself. Why large cap stocks? Because the rules of the game in the US are still different from those in Taiwan. Large cap stocks have financial transparency, industry competitiveness, and certain advantages that big companies have. These strengths are fully displayed in the US stock market. Just look at the earnings growth rates of the Magnificent 7. You can see earnings growth of 20% or 30%. Even after deducting all expenses, their profit growth is still that strong. Right, no matter how high their PE ratio is, it just shows that these are truly competitive companies. So you should. If you want to hold for a swing trade and earn a pretty good return, these are exactly the stocks you should be focusing on. Now, as for the other 493 component stocks, take a look. 2020 was negative and 2021 saw a big jump. Why? Well, that's because of the pandemic. Okay, so growth in 2022, then in 2023, it dropped again. In 2024, it's 5.1, and in 2025, it's 9.1. Pay attention to this 9.1 figure. We'll see it again later, because in 2026, this number changes. Now, moving on, let's look at net profit. Next, for net profit, we're talking about earnings growth rate. What I just mentioned was the earnings growth rate, and this is... Now we're talking about the net profit margin. Looking at the net profit margin, you can see that over the past decade or so, on average, the net profit margin has stayed in the double digits. In Taiwan, some companies are at 3 or 4%, which is pretty low, mainly because they're in downstream industries. That's why the performance used to be worse. But for example, let me also talk a bit about the past 2 years, specifically 2025 and 2026 for the Taiwan stock market. In the US, with such strong demand for AI servers, of course, Taiwan's gross profit margin has improved significantly. After this improvement, it will be reflected in the stock prices. Here, we also want to point out that the overall earnings growth rate is expected to be 12.9% this year, compared to 12.3% last year. These are both very good numbers. So, Next, let's take a look. Of course, the report released at the end of the year is more detailed. The main thing we see first is on the left. There are 11 major S&P sectors, right? I often mention these 11 sectors to everyone, and if you add the S&P itself, that's 12 categories. Let's take a look at the performance changes in earnings and revenue for 2025. The parts I've highlighted in blue are the ones I'm focusing on. The ones with the blue color and bolded box are the S&P 500, and the red ones represent the larger sectors, specifically the 5 biggest ones. That includes the 3 sectors where the Magnificent 7 are located, plus financials and healthcare insurance. Look here. Let's look at the earnings on the left. Information technology earnings growth rate is 23.3%, still very strong. Overall, the rate was around 22.1, still very strong. And for the Magnificent 7 overall, it's also around 22. Information technology alone has a 23.3% earnings growth rate, which is very strong. Communication services, then financials, and health insurance are also good. For industrials, the earnings growth rate is 7.3%. Now, we need to make a comparison. Let's compare this to the right side. The right side shows the revenue growth rate, ranked from high to low, so you can see that information technology is relatively strong. Look, it's 15.5 for information technology, 9.6 for communication services, 6.5 for healthcare, then utilities at 6.9, and then the S&P is also at 6.9. Next, consumer discretionary is at 4.6 and industrials at 4.7. Now, we especially need to emphasize that sometimes when you look at earnings and revenue, the best in both categories is, of course, information technology. So take another look at that. If you look ahead, is information technology still important? Yes, it's still very important. And where's NVIDIA? NVIDIA is in information technology. But it's not just NVIDIA. IT and tech as a whole are still a very important and outstanding sector. Although I think there was some noise at the beginning of the year that needs to be filtered out. Alright, so it might experience a more volatile sideways trend, but this sector can consolidate without dropping. Let me say it again. These major information technology companies with significant market cap, strong earnings and revenue growth, these important companies in this group can go through consolidation. They can't drop, because if they do, the overall pressure will be huge. Next, let's look at communication services, which is the second sector. Then, looking at financials, their growth rate isn't high, but their earnings growth is very strong. What does this mean? It means their profit margins are rising especially fast. This is something the US really emphasizes, as I just mentioned, emphasizing return on equity, shareholder returns, or return on equity or earnings growth rate. These are the kinds of stocks they like. So as we've been saying, maybe from the end of the year to the first quarter, the financial sector is really worth paying attention to. Here, let me show you. For financials, the fastest way is to buy large cap stocks. Or to be even quicker, just buy a financial ETF. ETFs are really convenient now. And if If you have a bit more capacity and are able to buy, then you can pick some large cap financial stocks to choose from. On the other hand, healthcare insurance also has really strong earnings growth. As you can see, actually, the revenue growth isn't particularly outstanding, and maybe you don't usually pay much attention to the healthcare industry, but the thing is, from an earnings perspective, it's really strong. Now, from the earnings angle, regular retail investors might not be that interested, but let me tell you, when it comes to healthcare insurance and financials, who really likes these? Institutional investors do, because the numbers are more predictable and manageable. All right, so another one is the industrial sector. Its revenue is a bit lower, but its earnings are at 7.3, which is still worth noting. Then there's also industrial utilities. Now, I especially want to mention, why have utilities always been considered boring and unpopular, with nobody wanting to pay attention to them? It's like, what's there to look forward to with water, electricity, and gas? But the thing is, the power demand from AI is a breakthrough at the margin, so you really have to pay attention to utilities. In fact, there's a good chance that utilities will have more to look forward to in the future. And then moving on, looking carefully at the expected revenue for the upcoming period for next year and considering the forecast for next year, the average annual growth rate is 15%, and it's been double-digit growth for 3 consecutive years. Of course, that's better than the 8.6 we just mentioned. The expected revenue for the Magnificent Seven is 22.7 billion. Last year's figure was 22.3, which is still good, but the issue is, among the top 5 contributors here, only 2 are from the Magnificent Seven, Nvidia and Facebook. Now, you might ask, who are the other 3 in the top 5? Sorry, the data we're using doesn't include that information, and we haven't purchased their database. If we wanted to know, we'd have to pay for it. So that's the situation. That's just how it is with foreign data. If you want more, you have to pay for it. We're just letting everyone know that even though we only have access to partially public information, it's still highly valuable as a reference and can be shared with everyone. Now, moving on. For the 493 companies outside the Magnificent Seven, their earnings growth rate for 2026 is 12.5%, which is higher than last year's 9.4%. Did you catch that? Did you hear a little meow there? There's something fishy going on here. It's a bit interesting. Why is the earnings growth for these 493 companies? This year, the forecast is 12.5%, while last year it was only 9.4%. Don't underestimate it, even though it only increased by this much, but it went from less than double-digit growth to over double-digit growth. And for these 493 companies, you can see, right? Let's go back to this page. Since 2020, looking at the 7 giants. In 2020, the 7 giants grew by 32.6%, while the others were down by 15.8%. In 2021, the 7 giants grew by 49.3%, and the others grew by 47.6%. In 2022, the 7 giants dropped by 16.3%, while the others grew by 8.3%. Then next, it's 33.3% versus negative 4.0, 37.2 versus 5.1, 22.2 versus 9.1. So what am I really trying to say? All the companies in the S&P 500 are big companies, but these big companies are being squeezed by the truly giant companies. So this is something we really need to pay attention to. So next year, will it be these so-called whether it's a rebound or a compensation, will these other companies get a chance? All right, let's emphasize this point again, because after all, you have to understand when growth stocks have already gone up for a while, sometimes it's value stocks that catch up. So if value stocks start to make up the difference, don't miss out. That's pretty important. And then another thing is, regarding the revenue growth rate, the forecast is that next calendar year's average annual revenue growth rate is 7.2%. This is better than the 10-year average annual growth rate of 5.3%. Out of the 11 sectors, 10 are seeing revenue growth. Only information technology and communications are, information technology and communication services are the 2 sectors with the highest growth. Right, and what does this mean? These are also the 2 main categories among the 3 major index groups that make up the Magnificent Seven. In addition, there's also the energy sector. Yes, next year, it's the only industry expected to see annual revenue growth, right? See, we still mention this to everyone. Although in principle, we try not to talk about specific commodities, but since crude oil is, after all, involved. It affects the cost of so many industries, but the situation of crude oil oversupply is also ongoing. This will make the entire energy sector relatively weak. Next year, it's also very important if energy prices continue to stay low instead of starting to rebound upward. This is actually more helpful for inflation. After all, when it comes to commodity inflation, raw materials make up a big part of it. And within raw materials, energy is a major component. So this is a really important part, and that's why we want to talk to everyone about it. Well, the energy sector, maybe its annual revenue growth and earnings are a bit weaker, but for the greater good, we have to make some sacrifices in the energy sector. Next year's projected net profit margin is 13.9, which is better than the 10-year average of 11. Also, if next year's net profit margin is indeed 13.9, that could be the highest annual net profit margin since this index, the fast set, started tracking back in 2008. Alright, but of course we have to remind everyone that to confirm whether it's really the highest annual net profit margin, you'll have to wait until the end of 2026, or the first quarter of 2027 to actually see if that's the case. But let me add one more thing. Stock prices are forward-looking, so you still need to keep a close eye on whether their earnings will continue to grow, and whether profitability will keep improving. That's the nature of the stock market. When we invest, we're always watching these kinds of things. There are a lot of data points, so we'll keep helping everyone track things like profitability and profit growth, which are really important for US stocks. Now, regarding earnings forecasts, let's first look at a table. If you look at 2026, for example, revenue is about 15, and profit is 7.2. These numbers are all better than the past. For the Magnificent Seven, it's 2.7. And for the other 493 companies, it's from 9.1 to 12.5. So compared to the big swings in the past, what we want to highlight is that next year, the earnings recovery for the 493 companies, that is the non-Magnificent Seven companies, is significant. Actually, the recovery in earnings will drive the recovery in stock prices, and that's a pretty important factor. It's possible that this is where the returns from stock picking will come from. Alright, and as we just mentioned earlier, next year's net profit margin is 13.9. You can compare it to the left side, and that's actually a really high number. This year it's 12.9, so if next year it's 13.9, that's even better. That means profits are growing, which is a good sign. Let's talk about one thing here. If their profits are expected to grow, then wouldn't you expect the stock price index to keep going up as well? Okay, we'll have a chart to discuss this with everyone in a bit. Now let's look at the expected revenue and earnings for 2026. This part gets interesting. Let's first look at the earnings. As before, we highlighted this part. Here it is. The earnings are boxed in, the ones with color. The blue one represents the S&P 500 index itself, and the ones that are highlighted are those with the higher weighting. Okay, so let's first look at information technology, which is at 28.5. That's still very good. If you compare it to the revenue on the right, it's still at 17.4, right? When we talk about looking at the numbers from a fundamental perspective, this is still the top dog, you know? Whether or not there's an AI bubble, what we're discussing now are the fundamental numbers. If you look at this, analysts look from the bottom up, meaning they review individual stock reports and then look at the bigger picture. In this situation, information technology is still very important, but let's quickly take a look at the others as well. Communication services, the S&P itself has a projected earnings growth rate, and then communication services is at 11.8, consumer discretionary at 11.2, financials at 9.6, and healthcare at 9.6. But there are two that have moved up to the front. One is called materials, which is at 22.0, and the other is industrials at 15.4. Now, everyone, if you remember, we talked about materials this past Monday, and we mentioned some precious metals. Actually, when we look at materials, we need to provide a concept here, regardless of what it is. Just whether it goes up or down, you need to understand why there are expectations for materials this year. That is, for some key minerals, actually, both the US and China are looking to expand, or rather to ensure their sources of certain critical minerals. So there's a sense of competition here, which provides some support in this area. No matter what the price is, sometimes they focus on securing the quantity rather than the price. For example, they need to have a certain amount to maintain the stability of their industrial production, in China's case, to ensure a stable supply of raw materials for industrial output. For the United States, it might be about preparing for future developments. They need to secure these raw materials for future use. So for them, quantity is more important than price. If everyone is scrambling for quantity, then the price will naturally go up, regardless of whether there's an actual increase or not. At the very least, even if it doesn't benefit you directly, or maybe investing in that particular commodity itself might not be profitable, for those involved in mining these raw materials, or acting as intermediaries, or even in the shipping industry, this is great news. Why? Because your profits will improve. Once your profits improve, your PE ratio is likely to expand, and the stock price will move. Similarly, industrial stocks are in the same boat. The US is moving towards reindustrialization, and we've seen this before, like with the defense industry and some others. Automation and things like that are also driving growth. So we're seeing that defense and industrial stocks are expected to be relatively strong as well. And there's one more thing. As for utilities, we just mentioned the 9.6, it was brought up. But when it comes to earnings, they're not particularly strong. That's right. They only have a 9.6% earnings growth rate. But we need to look at something else. What about their revenue? Its utility sector has a 7.1% revenue growth, which is actually not much different from the overall index's 7.2%. So why am I pointing this out? Basically, it's driven by increased demand for personnel. In other words, actually, to some extent, power companies are being held back because they can't generate enough electricity, not because there isn't growth demand downstream. You get what I mean. It's your own supply capacity that's limited, which leads to lower revenue and earnings growth. That's basically the situation. Now, moving on, we have a rather interesting table below. What is BHS? BHS stands for Buy, Hold, and Sell, which are recommendations for buying, holding, or selling. Here they've divided it into several categories, including the C category, and also added S and P, making a total of 12 categories. They've organized and categorized them for statistical analysis. Now, let's take a look. The S&P 500 is represented in blue here, with a value of 57. On the left side are those higher than the S&P, meaning the proportion of buy recommendations is higher than the S&P's 57. On the left, you also have non-essential consumer goods. After consumer discretionary, those that are lower than the S&P are shown in green. So for consumer discretionary, it's 57, and the S&P is also 57. The reason for the difference here is just some rounding of decimals. Please bear with us on that. So that's basically how it looks. Now, let's see which sector still has the strongest buy recommendations. It's information technology and then, energy. So even though we see that its overall revenue is falling below expectations, there are still a lot of buy recommendations. What does that mean? From an analyst perspective, it might be seen as having bottomed out. But the problem is, I personally don't think energy is an industry I would be optimistic about yet. Why? Because it feels like oil prices haven't finished dropping. So that's why here, maybe, let me report to everyone the statistics they've compiled. Communication services are still doing well. As for raw materials, you can see there are still a lot of buy recommendations, about 60%. Then healthcare is at 59, which is also relatively strong. Consumer staples are at 57, which is about average. Real estate is at 85, finance at 54, and industrials at 54. Utilities are at 48, and consumer staples are at 44. What we see here is that consumer staples are particularly weak. Of course, this is related to public demand and their cost control. It's especially weak. All right, so in fact, if we look at this, looking at these sectors mentioned earlier, there are still plenty of investment opportunities within them, with many very attractive individual stocks. Now, let's take a look at this. The revenue forecast for 2026. Do you see here, the green part on top is buyer. Of course, well, because in the US stock market, price increases are shown in green, so don't assume that green means something else. It's not like in the Taiwan stock market where green means a drop. So their convention is the opposite. Their sell is shown in red and red is over here. Then the hold rating is yellow. So you can see that the general trend up here is what? Oh, the proportion of stocks recommended as buy keeps going up. So where is this increase in buy ratings coming from? It seems like it's coming from the hold category. In other words, stocks that were previously rated as hold or neutral are gradually improving and being moved over to the buy side. So this is pretty good. And the sell ratings are still staying at a relatively low level. So the overall market sentiment from a fundamental perspective looks okay. All right, and in addition, they've made an estimate here. There's a bottom-up forecast analysis here. Oh. Let me talk about this here. Hey, this isn't just my personal opinion. We're just reporting the statistics. You can see that FactSet is tracking a number here. Let's take a look at the reference they're giving. By the end of 2026, according to their bottom-up analysis, the S&P could reach 7,968.78 points. 7,968.78. Just take note of that. Actually, if you want an easier number to remember, just round it up to 8,000. Because this report, well, this particular one was released on December 12th. Now, what I want to mention here is that this series of reports actually started coming out gradually from December 9th. So if you go back and look for it, the numbers on the website might be a bit different from what I have here, and that's because the numbers get updated based on the report release date. So since they update it, I won't change mine. Anyway, we'll just use what we have here. It's just for reference, that's all. The main thing is, his estimate at the time was probably based on the closing price on the 12th, which should have been 7,769 points, or maybe 7,601, or 6,901. But the actual closing value was... the closing price on October 31st was 66,845.50 points. Okay, if you calculate it from here, you'll see there's roughly over 16% growth. Now, we should also mention that he was actually quite responsible here. He included previous estimates as well, because here they're compiling the estimates from all these analysts in the US stock market, so many analysts' projections are included. What's the difference between the estimated value and the actual number? So here we're just letting everyone know, and we've also listed the previous estimates from 2016 to 2026. Of course, 2026 is a projection. In 2015, actually, it was just completed as well, and after I made the adjustments, you can see that the green bars basically represent situations where things didn't meet expectations, while the blue bars are better than expected. Now, I want to point out something. There's a kind of inertia here. If it's a bull year, you'll notice that the final performance of the index is usually higher than the estimate. So this is something I want to highlight for everyone. If the bull market continues, the S&P 500 constituent stocks in the US generally have a stronger ability to beat earnings expectations. But the problem is, it's not like everything will always go smoothly every day. For example, in 2022, because of interest rate hikes, the market dropped by 1,400 points, and that optimistic atmosphere was actually interrupted. We need to honestly report this to everyone. Also, looking ahead to 2026, the information services sector is expected to have the largest increase, nearly 20%. The expected increase for the financial sector is the smallest, at about 8.3%. Also, there's another point to mention. Right now, it's the end of the year and the beginning of a new one. Usually, the closing price of the index at the start of the year tends to be overestimated. In other words, they estimate this year's index at 19,968.78 points, but by the second or third quarter, there might be a pullback. The foreign analysts are actually pretty honest. They tell you that in the past, there's been a tendency for a pullback during this period. So this is just for your reference. I think what's important is that judging from this year's revenue, earnings, and fundamentals, things are still on an upward trend. As for the estimated high point of the stock price or the stock index, I'd suggest not getting too hung up on the exact number. As long as you understand the general direction, that's what matters. After all, when the July financial reports are released, any new information that comes out can immediately affect the entire stock market's movement. That's actually the more important factor to pay attention to. Another important point. We still need to remind everyone that while it's crucial to look ahead, it's also necessary to look back at what has happened in the past. So, as I mentioned yesterday, on Wednesday, the thing we need to worry about most is the time lag, meaning the time lag in monetary policy, or even the overall. The timing of when the expected easing will actually happen, this could be a major reason for significant market fluctuations this year. And of course, doubts about AI in the market won't disappear so quickly either. So, starting in January, the earnings season will begin. Around late January, roughly the third or fourth week, the big tech companies will start releasing their earnings reports, and this will continue all the way until Nvidia, which is always the last one. In fact, if you want to see reports even later than NVIDIA, you'll have to wait until March to see the earnings from Micron and Broadcom. That's when the real earnings season action happens. Otherwise, generally speaking, for the Magnificent Seven, 6 of them usually release their reports between the 3rd and 4th week of the first month of earnings season and the 1st or 2nd week of the following month. So basically, all the reports are announced within that time frame. Alright, so while everyone is waiting for NVIDIA, now you see, besides waiting for NVIDIA, we also have to wait for Broadcom and Micron, especially for memory stocks. It seems like this sector currently has the highest visibility and consensus in the market. So we still need to come back and emphasize this. The S&P was up 16.39% last year, and in 2025 it rose 16.39%. Now, for this year, the overall S&P is estimated, at that time, the forecast was around 15.5 to 16%. In other words, the estimated increase for the S&P this year is about the same as last year, but we need to point something out. Last year, it actually dropped by about 18.99%. No, not 18.99. Let me correct that for everyone. It was 9.90%. So what I want to say here is, at that time, it was because after Trump came into office, he started threatening to impose tariffs on Canada, Mexico, and China. And after those tariffs were implemented, the market started shaking and trembling all the way until early April, when the retaliatory tariffs caused a big drop, nearly 19%. Wow. And I should remind you, at that time, Musk was still out there hyping Doge, right? So after that nearly 19% drop, the market started to climb back up. Then, around mid-November, there was another drop, about 4.56%. But we need to mention something here. You have to be careful, because next year, the index might still go up for the whole year. Maybe it'll be higher than the expected 15 or 16%, or maybe a bit lower. But you need to watch out, because there's a chance that by the end of the year, during the middle of the year, the intraday volatility could be quite significant. Last year, there was a correction of 18.99, basically 19%. After that, it went up a total of 16%. But you need to be careful. If something happens this year, is it possible that there could be events during the day or mid-year that cause even more volatility? And then, looking back at the whole year, there was still an overall increase. But the question is, during the year, did those corrections cause you to change your original judgment or the direction of your trades? This is something you need to pay attention to, and we want to remind you of that. Also, in 2024, the S&P went up by 23%. Looking at this year, there were fewer corrections, only 2. One was about a 5.5% correction, and the other was about an 8.5% correction. And then in 2023, there were also corrections. One was a 7.75% drop, and another time it was a 10% correction. Yeah, there was a correction of over 10%, but in 2023, the market also went up by 24.23%. So 2023 and 2024 were both pretty good years. Wow, gains of over 20% are really impressive. And let me remind everyone, look, in 2023, it went up 24%. In 2024, it went up 23%. And in 2025, it went up 16%. By 2026, you have to realize this is a stock market that's already been rising for 3 years straight. So why do we keep reminding everyone to be cautious about volatility? Well, even if the whole year ends up positive, the market swings could get more intense. Why? Because after such big gains, there's bound to be some pressure for adjustments. So just another reminder for everyone, this is something to watch out for. You really need to be a bit more careful about this, yeah? We keep reminding everyone to be careful, to stay cautious. Why? Because after a big run-up, you really need to watch out. And right now, you have to look at the Taiwan market reports in more detail. So this part can be pretty tough to get through. Finally, let's take a look at 2022. In 2022, the market actually dropped nearly 20%. Specifically, it fell 19.44%. But when we look back at it afterwards, the most important thing in 2022, if you look back at October, after the CPI was announced or revised, people started to realize, hey, maybe US prices have peaked. And then the Fed's rate hike cycle. It had reached its peak, so the index started to rise. Now, looking at our current situation, what we really need to watch is that this year we still expect the Fed to cut rates by a quarter point as scheduled. But in the market, people are betting on 2 cuts. Analysts are talking about 4 cuts, and Trump says he might want even more. But could the risk be that this year is the opposite of 2022? Back then, we saw the Fed's interest rate policy reach a peak, a divergence hit its highest point, and then the stock market started to move. Looking at it now, could it be that interest rates will be cut to a certain point, to a bottom, and that's when things start to become unsustainable? It's not necessarily about raising rates. If they just hold and don't raise, you need to be careful. And this timing might not happen in 2026. It could be 2027, or it could happen earlier or later. You really have to watch as things unfold. That's why we've mentioned to everyone before. The trend of the CPI this year is a key factor in how much rates will be cut, and it's also a crucial point for you to watch for any potential policy mistakes down the line. So it's a bit tricky, and I have to ask everyone to keep following our program. At least while I'm here, I'll definitely keep everyone updated on this situation. And if it's next year, other analysts and instructors will also help keep you informed. So in addition, last night, Wednesday night, the initial jobless claims numbers were released, and they turned out to be unexpectedly strong. The main thing to note here is that theoretically, this data covers the holiday period, meaning it reflects the volatility around the Christmas holidays. So for example, the initial claims dropped below 200,000, and the continuing claims fell to under 1.9 million. Both of these are really strong numbers. But the key point here is that these figures include the Christmas holiday period. Let me tell you, when it comes to January, when the numbers are released next Thursday, or maybe the Thursday after that, you might see that the data for that week gets revised, or you might see a significant jump in the numbers that follow. Don't be surprised by this. Every year during the new year or whenever there's a holiday, it's always like this. At that time, if you look at the 4-week average, it'll be more accurate. So don't get too anxious. Just keep an eye on it and take your time. So when this data was released, we saw that expectations for rate hikes and cuts did change a bit. Basically, when interest rates go up, the expectation for rate cuts decreases. In fact, there wasn't much movement in January and March. The main changes were concentrated from April to October, where things generally trended upward. You might want to take a closer look at the markings there. Basically, what I mean is, for example, in October, it went up from 3.096 to 3.103. That's the general idea. So you can see that the expectation for rate cuts has narrowed a bit. In principle, this mainly happens between April and June, up to around July. After that, the changes are relatively minor. The market still expects, from a trading perspective, that there will be one rate cut in June and another one by the end of the year. All right, these 2 points are pretty much confirmed, and that hasn't changed. So the weekly numbers, the one-way weekly numbers, have seen some adjustments, but not a complete overhaul. Okay, and in addition, the US dollar index is at, on Wednesday and Thursday at the close, on the last day of 2023, it saw a slight uptick. But the problem is, for the whole year, it dropped by 9.4%, which is the worst performance since 2017. On Friday, it dipped slightly and basically moved sideways. As for the 2-year bond, it went up on Wednesday, but for 2025, the performance, well, US Treasury yields are trending downward. You can see from the moving averages that it's heading down. So the performance in 2025 is actually the best since 2020. Now, the bigger issue, I think, is that I should probably mention the 10-year. Here, last Wednesday, it went up to 4.51. Again, for 2025, it's still the best performing year in the past 5 years since 2020. But what we need to pay attention to is what should you be watching going forward? It's whether the 10-year Treasury will cross above the 200-day moving average. If it does, you need to be careful. You need to interpret whether this is due to an improvement in the economy or an increase in inflation. This is something you really need to pay attention to because the 2-year Treasury hasn't moved much, but the 10-year has. Long-term rates usually reflect inflation expectations or changes in the economic outlook more significantly, so everyone should keep an eye on this. You probably need to keep watching this. As for the S&P, well, trading is still pretty light toward the end of the year, so it's still going down. Honestly, the drop this Wednesday was actually a bit on the large side. But if we look at the pre-market performance later, it's actually reversed. On Wednesday, Nike was going up. As for the others, Molina, which is in healthcare, and TransDigm were also rising, but there weren't many others going up. There were actually more stocks that were falling. Then if you look at the 11 S&P sectors, it's pretty rare. On the 31st, all of them went down. And Because of this correction, the volatility index went up and the equal weight index went down. Oh, sorry, it dropped by 0.88. In the end, the number wasn't updated, but it fell by 0.88 to 7,763.92. Okay, and that's not included. The equal weight index excluding AI dropped by 0.86 to 104.32. So actually, all of these declines were pretty significant. Then over on the Dow Jones, it also fell, down 0.63. The only leader was Nike, and aside from that one period, only Nike and 2 others were up, so just 3 stocks in total rose. So you can see that right before the new year, there was quite a bit of selling pressure in the US stock market. That one also dropped, down 0.76. The Philadelphia Semiconductor Index fell as well, and the leading gainer was kind of odd. Yeah, as for the top performer, it was only TSMC that went up on its own. The rest were all down. Then for Global Foundries and India Rainbows, they also dropped, and it was pretty bad. Intel in particular fell 2.81. There were also 6 stocks that ended flat at 0. Between 0.2 and 0.6, there were 15 stocks that fell between 1 and 2%. So it looks like the pressure on Wednesday, the 15th, was actually pretty significant. The Magnificent 7 all dropped too. Surprisingly, not a single one went up. Of course, Tesla had the biggest drop among them. So next we'll switch over to look at the futures market. There's actually a very different situation there. Let's take a look. We can see that it's relatively weak. That's true. But if you look, last Wednesday closed weaker. But if you look here at the futures, the Dow Jones futures rose by 0.3, and the S&P futures rose by 0. Above 0.55 is good. And then the Nasdaq rose by 0.9, and Doha went up by more than 0.9%. So actually, you can see here that the performance was better. Also, let's take a look at the pre-market gains. Did you see that? Hynix only went up by 3.63 thousand. KLA is also doing well. KLA, is it KLA or another KLA? I always get confused. It should be KLA. KLAC should be KLA, right? Both of these went up by 3%. Micron rose by 3%, Teradyne went up by 2.8, SanDisk rose by 2.6, ON Semi went up by 2.4, and Vishay increased by 2.6. And then Supermicro went up, Microchip rose by 2.46, SMCI went up more than 2%, and so did Coherent, both over 2%. Then Seagate is also rising. If you look down this list, these are all names you're very familiar with. AMD went up by 1.83. Why? Because these are all tech stocks you know well. Corning Glass, an industrial stock, went up by 1.7. You can see here that all of these are up by more than 1%, over 1%. And the last one in the top 25 is Avago. So from the performance of individual stocks, today looks like it's gearing up for something big. Maybe everyone really is still on holiday, so there hasn't been much action before now. As for some of the stocks that dropped, the first one we see is Progressive, the auto insurance company, which fell by 5.93. Then there's another one. BNY refers to Bristol Myers Squibb, which dropped by 1.02%. As for the rest, you can see that the declines are all less than 1%, and most of them are just very minor drops. So it looks like for this year, the Taiwan stock market had a strong start today, with the index rising by more than 1%, right? The overall market was up over 1%. And today it seems like the US stock market is showing a similar trend as well. Looking at the futures and the component stocks, it feels like today is optimistic, and it should close higher. As for the US dollar, it's like this. The 2-year yield is rebounding, and the 10-year yield is also rebounding. So the Dow futures seem to be up about 0.55% and are holding steady. We'll wait for the main market to open. That's about all we're seeing here, so let's take a look at everyone's questions. So to sum up today, it looks like at least today will be a strong start, with individual stocks showing very positive momentum. Also, it looks like this year is shaping up to be a good one. If January benefits from the so-called January effect, then what you need to watch out for is whether after the Lunar New Year, in other words, after February, there might be some volatility as earnings reports come out and new situations arise. But since the market has already gone up quite a bit, the details in the earnings reports will be very important, so everyone is paying close attention. Now, let's take a look at your questions. Yeah, there were 2 singers, but I don't know who the other one was. We only recognized this one and then Ame. Well, people my age know singers like Ame, but I don't really know a lot of the newer singers. Ame was performing in Taitun, and this afternoon I happened to listen to her for a bit. It was actually pretty good. So about that, you asked about the trend, right? Let me talk about it now. I won't read it out loud. I was warned about this, so I can only say this. For these kinds of precious metals, recently, the industrial demand for silver jewelry has also been quite strong. Lately, there have been some signs that certain exchanges want to cool down the silver market. As for gold, if I remember correctly, before the Lunar New Year, before the Gregorian New Year, there was a correction. And then as for today's opening, the spot price should have already started to rebound. But I think you might need to be cautious here, especially when it comes to watching for rate cut expectations. Like I mentioned, the timing difference. The actual timing of the rate cut, the real action, and the difference between that and your expectations, this will affect how gold prices perform. Looking at the whole picture, I think gold will see a moderate increase this year, not a year of wild surges. It's still a moderate rise, unless something happens to make it surge wildly. So in principle, the outlook is still for an increase, and that hasn't changed. In times of moderate growth like this, it's generally more favorable for gold mining stocks to perform well. So let's take another look. Free and easy wandering. Thank you for your comment. So I'm not sure if anyone has any questions. If there aren't any, then that's about it for today's live stream. All right, see y'all next week.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.